at the end of the day, we're here to talk about we're here to talk about companies' outstanding shares, right? So we're here to understand why is it important for us to know how many shares are outstanding for a certain public company, for a certain issuer, whether he's OTC or a listed company or reporting to the SEC or not.
Or even a private company too. That applies to private companies as well. Yeah.
100% applies to private as well. The reason why we care, us on this call, about outstanding, or at least the reason why it first started, was because we wanted to know how many shares we could own after doing a conversion of a debt that a company owes us without having to file any kind of beneficial ownership reporting requirements to the SEC.
So expand on that, because this is, you used a lot of very complicated terms for the average retail investor, right? Someone who doesn't come from your background, right? So explain to us, like, what is outstanding shares, and how does it like define the company value or the company market cap?
Well, the direct definition.
All right, let me chime in.
The definition of the authorized net, and then we can get back to it. Paul, if you want to add into that, go ahead. But really, at the end of the day, a company has its bylaws, it has its certificate of formation, right? And when they create those type of documents, and I'm not an attorney, so don't quote me legally or anything like that, but
not a financial advice.
Yeah, anything said on this call is not financial advice.
We'll have to say that in the beginning, actually. So that's another thing as a disclaimer.
And at the end,
run for your money. You exactly don't.
Whatever we say, do the opposite.
Exactly. 100%. We say sell by.
Exactly.
But every company, when they create themselves or whatnot, they have their bylaws, their capital formation documents. They'll go ahead and they'll say, hey, we have X amount of shares that we authorize, and they start issuing shares to their management, to their founders, and so on. And then they have a capital of shares that they can go ahead and issue in order to do certain activities like raising money, like doing acquisitions and so on, or employee benefits, options and so on that come out of that pool of shares. We can come back to a real definition of how it looks, but that's pretty much, I think, the gist of it. And then for us, back to what we do, so we provide loans to companies, right? And our loans allow us to convert the debt into equity of that company, right? So for us, the outstanding shares was important, or is important, because we need to understand what that number of ownership really means. What does a 4.99% of the company really mean as it relates to dollar value? That's
why 4.99 and why 9.99?
After 4.99, you have to go ahead and file a beneficial ownership, a 13G, so it's an SEC form, to notify the investing public that you own more than 4.99%. If you own more than 99%, then you're technically an insider in the company. And by being an insider in the company, you are actually restricted from doing certain things like selling a certain amount of shares at a time. They say you're an insider, right? You're privileged information. You own too much of the company. You can't do certain things. And again, we can go into more detail at a later time and whatnot of what it really means to be an insider, to really have 9.99% ownership. What are the rules of selling your shares as a 9.9% owner of the company? So we really wanted to always, we always actually put a blocker in our transaction documents that don't allow us to go more than 4.99%. Because really, legally, if you have the opportunity, if you can go over 4.99, even though you don't at this point, but you have the option to do it, you're supposed to file something to let people know that you have the option to be more than a 4.99% owner of the company. So for us, it was really important to stay below that level. And that's kind of how we came up with, okay, how do we monitor a company's outstanding shares? And how do we monitor so we know every time we want to go ahead and convert, let's say, what does that dollar amount mean? What does that share amount mean? And that's how we kind of came up with this dilution tracker, right? This shit tracker, right? To see what these companies are doing to their cap formation, I guess you could say, right? To the cap structure. How are they diluting? How quick are they diluting? How often are they issuing shares? And then we even got even smarter, right? We wanted to really understand why are they issuing shares, right? So when we start seeing a company go from 10 shares outstanding to 20 shares outstanding, they just doubled their outstanding shares, right? They just diluted their worth, right? Depending on what the price is of the stock or whatnot. But we can go into numbers too. A dollar a share, 10 shares outstanding is $10. $1 a share, 20 shares outstanding now is $20, right? So that's how you determine your market cap too, right? So market cap is what? Number of shares outstanding times your share price. So all this is starting to become more relevant to the retail trader. You want to know how many shares do you really own in a company, and what does that mean for your beneficial ownership? How much do I own of this company? And if it continues to increase, why is it increasing? Are they issuing shares because somebody else is converting their debt and selling their debt into the market and diluting the outstanding shares? Is it because they...
And that's usually a bad sign, right? Like when outstanding shares are increasing just because somebody else is converting, it's typically not a good sign for the company's health.
Typically speaking,
yeah.
Typically speaking, the stock is usually taking a hit. Sometimes, you can't predict how it's going to trade, right? But it all depends, who owns the shares, how they sell the shares. Are they dumping it? Are they doing it a percentage of the volume of the traded, of the company? There's a lot of rules and regulation on the broker side too of how much liquidity you can, how much of a market participant you can be in that liquidity pool of that certain day and stuff like that. So those are all items. But there's also, good things they could do, right? One, they could do an M&A activity, right? They use, what's one of the biggest reasons a company goes public? To use their shares as currency. So you don't have to use cash to buy another company to bring, that brings in more operations, more revenues, more net income. You can do it with shares, right? So that's a big reason why companies go public, to use that as a currency. If you do an offering, right? And offerings could be related to a lot of different things, right? It could be, private placements as equity. It could be as debt. It could be as, registered offerings, stuff like that. So you need to be able to monitor what type of offering they did and what the terms of the offering was to really understand whether it's good or not good for the company. But sometimes they do it at the market. Sometimes they do it a premium to the market. Most of the time, depending on the company and the nature of it and their health, it's at a discount, right? Sometimes they're doing...
So explain, if that's in a discount,
meaning
what does it mean?
Yeah, so meaning the company's trading at $1 and they're offering shares at 80 cents to this individual or to this investment group or institutional investor or whatnot.
So what does it mean? It means that they're issuing new shares at 80 cents, raising money at 80 cents for a company that basically, like for stock that it's actually at $1. So automatically it kind of like probably withdrawn the price back to 80 cents. So
correct. Once, a few reasons why that could
not
happen.
necessarily, not always going to happen, of course, but like...
What usually happens when companies raise money at a discount, the market is going to reflect that. I mean, let's say that you're a shareholder, that you bought shares at $1 and somebody else is getting shares at 80 cents. The market doesn't like it. So usually companies, when they issue shares at a discount, eventually the market price goes down to the offering. So as if it's trading at $1 and they sell shares at 80 cents, sometimes it's in a matter of hours. Sometimes it takes a couple of days, but the price usually goes down to 80 cents. It's basically, if the issuance was done at less than market, there's gonna be selling. I mean,
And this is the key. Like, this is the key to what we've built for ourselves, right? And what we want to put out there is that it's all about how quick you get that information, right? So if I see that the shares were increased by X, and I'm able to review a filing and see that there's somebody that's converting, right? So I know it's a dilutive issuance. Or if I see there's an 8K or there's a press release that they went ahead and they raised money at X while I'm an owner at Y, depending on the situation, I want to get out as quick as possible. I don't want to take that. I do not want to take that risk because usually the guy that bought it is trying to capture that delta, right? He's trying to take that spread that he just created for himself and get out. And at the end of the day, the normal investor is the one holding the bag. So now, and it's even more important to know in some cases who is the investor that came in. Because if Warren Buffett's the one that came in and took a position, or if Nvidia came in and took a position in a company, which we've seen firsthand, and because we were able to follow an insider filing of a 13G through our SEC keyword filings and whatnot, we're able to see that, hey, Nvidia just came in. This thing's going to run. This is good sentiment. Even though they bought stock at $6, which could have been a discount at the time or not, we know that, hey, it's a real investor. It's a good quality investor. It's an investor that's bringing something to the table. So if you ask me, that could be a good indication, right? It's a leading indicator that something good could be coming.
yeah, and I guess also going on a different tangent, the reason why we were interested in creating a tool like this is because issuances of shares are not typically disclosed by companies. It's not an obligation for them to disclose it. You don't get an email, you don't get a notification, you don't get it's not publicly, it's publicly available, but it's not publicly disclosed. You have to look for it. It's not something that's going to pop up on your phone. You're going to get, hey, Nvidia just issued 100 million shares. You're not going to get that. And depending on where the company's trading and what the rules and regulations are, you need to go and look for it in different places. OTC traded companies need to go to their transfer agent, and then it's going to be updated on the OTC markets. For NASDAQ or New York Stock Exchange or bigger exchange listed companies, usually gets updated in their investor relationship portal, or it gets updated in the latest filing, whether it's a quarterly or it's an annual or it's a semi-annual, whatever the filing is. But it's not easy to find, and there's no one source for you to find it. So that's why I went ahead and created this, so we can get a notification, so we can know as quick as possible, because as Zolan said, this affects the stock, and we need to know as quickly as possible. Investing, it's an information game. Whether you
Paulo, explain us what a transfer agent is.
Okay, so I'm gonna try to do I'll do my best. If I get stuck on, Ari, please come in. So a transfer agent is pretty much a third party that gets involved with a company that is in charge of keeping the books of how many shares the company has authorized, which, as we discussed earlier, it's in their statement of incorporation, it's in their bylaws, it's in whatever. And they also keep track of how many shares are outstanding, how many shares have been given to investors, who owns them. It's a part of what transfer agents do. So for example, when companies vote on their annual shareholders meetings, the transfer agent is usually the one in charge of sending the proxies to all of the investors. When companies issue dividends, the transfer agent is in charge of determining who is the shareholder at the time of the dividend when it's declared. So that's what transfer agents do. And also, for example, when groups like us get issued shares, it's the job of the transfer agent to make sure that our shares are deposited in our account. And those are movements that need to be approved by the transfer agent. Every company has a transfer agent. There are transfer agents for small companies. There are transfer agents for big, large, mega cap companies. But every company needs to have a transfer agent, and that's their job.
It's a record keeper. They are the record keeper for the public company. They keep the list of all the shareholders of the company, how many shares each person owns, where, how, what, all the dates, everything. So every issuance that's ever happened from a company, the transfer agent is the one that actually does the issuance, right? So the company has to give them a resolution, a board instruction to go ahead and issue those shares. The company can't just issue. It's going through the TA. So
to summarize, going back to what you said at the beginning, one of the main reasons companies are going public is because they can use their shares as currency, and the transfer agent is basically the bank for the shares. Basically, the bank of the shares, the bank for the currency of the shares, right? He keeps the ledger. A bank is keeping the ledgers for your cash.
yes.
The transfer agent is keeping the ledger
Correct.
for your shares.
Correct.
So that's exactly, I'm trying to kind of like simplify it for the less sophisticated investors. When I jumped 6 years ago, when I jumped into this space and I knew almost nothing, I was sitting next to a loan every day and I kind of like learned. So I can go into the head of someone who's new to this and kind of like understand and ask the questions where we're using terminology that can be a bit difficult to understand. So that's why I kind of like want to elaborate on that.
Yeah, I mean, again, I think that's a great analogy, and I think it's just at the end of the day, everything flows through them. So as it relates to issuances, as it relates to shareholders, to dividends, X dates, I mean, they do it all. They have to be involved on the day-to-day of share movement for the companies. And they are the ones that provide that information, Paulo, to the OTC markets at the end of the day. Yeah, they're the ones that provide that information. And like you mentioned, it's either you're getting it from OTC markets or you're getting it from SEC filings, quarterlies, yearlies, Ks, sometimes regular AKs or whatnot, but that's what you're relied on. A regular shareholder, if you went and bought, I think, a share of Apple, and now you're a shareholder, I don't know if you can reach out to Apple or Apple's transfer agent and say, "Hey guys, I want to know what your latest outstanding shares is." I don't know if they give you that access. I don't know.
I mean, you can, but they're not necessarily.
Are they going to tell you?
I think some will. I think it all depends on the relationship between the company to the transfer agent and what information they are okay to disclose with retail investors. Since the transfer agent knows who are all the shareholders because he's keeping up the ledger, then he can decide based on the company's orders if to provide or not, right? Like, I think
at the end of the day, he's an agent of the company. He's not an agent of the shareholder, I don't think.
Correct.
Right? He's maintaining the books and records of the company at the end.
Correct. So the company is the one that pays the bills for him.
Yep, exactly. So, that's at that. I mean, and there's so much more, I guess, information that you can get out of really understanding why they're issuing the stock. And I think it could also give you more clarity on whether you want to be an investor in that company, right? Do you want to continue to invest in a company that continues to dilute?
I guess that, I mean, if we wanted to simplify, put it in an analogy, I mean, a company, you can see it as a pie, an apple pie, let's say. And each share is just a small piece of the pie. Even if you're shareholder and you only have one share of Apple, let's say, for example, I have a share of Apple. I have a small piece of that pie. And the companies, as you said before, they can use the shares as currency. They can use it to do good, to buy things, to grow. So your apple pie gets bigger. So in theory, your small piece gets bigger. But it can also do it for the wrong reasons. And so what happens is that if the pie doesn't grow and you get more slices, your slice is going to get smaller and smaller and smaller and smaller. So what you as a retail investor or as any investor, you would like to see a company that issues shares in order to make the pie grow. If it's not making it to make the pie grow, you're only losing money. Your piece of the pie is getting smaller. So you need to You need to be aware of that. That happens all the time. Companies do it all the times. The companies are very smart. They know ways to raise money. Or they have shadow things, that shady things that they can do. There are good things that they can do. So that's something that you need to be aware of.
Before you know it, they go ahead and they increase their authorized now because they used up all their shares.
Yeah.
That's
And so you started with a good piece of the pie, and now you have only the crust, and then you can't do anything with it.
And now I'm hungry.
And now you're hungry. Now
You're
your
talking
wife
about
comes and
pies.
yells at you.
Exactly.
And the biggest value here, that we've created with this kind of tracker, right? This dilution tracker, this software that we have is that we monitor the changes as they go. So like if you went on OTC markets today and it's a transfer agent verified information there, meaning that they're up to date, let's say, you only have the number of what the outstanding shares is today. You don't know what it was the last time they updated it, and the last time they updated it, and the last time they updated it. And that's where value really comes in. Knowing how much this thing is increasing every time. Understanding what percent it's increasing by every time. It shows what they're doing, how frequent they're doing it. And again, like I mentioned earlier, you can actually time it with an event maybe, right? So if it's for a good reason, let's say they raised money, and hopefully they raise money at a premium to the market, or at least at the market or something like that, in order to grow or whatever. You can tie it, hey, XYZ company increased by 2.5% today, but this is why, because there's a press release and there's an AK that's showing you, oh, these are the shares. Okay, makes sense. In other cases, let's say as a convertible note holder, right? Maybe there's multiple note holders in there. I'd like to know who else is selling. How quick are they selling? How aggressive might they be? So if they're converting over and over and over again, and the company's issuing shares over and over and over again, that outstanding is going to increase over and over again, right? So I can actually look at the number of shares that changed between the last time I converted and received my shares to the next time I'm doing it. And if those shares increase more than what I converted, that means, hey, what's going on? More shares got issued. I'm not alone here, guys. So, okay, who else is playing in the sand? Are they playing nicely in the sand? How long is it going to take? So there's a lot of questions that can derive from it. And I've caught multiple companies, lying to my face at the end of the day, telling me I'm the only person, I'm the only one with shares. Nobody else has debt. Come on. Numbers speak for themselves, right? They're just facts at the end of the day. And these are just verification tools. These are tools that the normal investor needs to understand, needs to have, needs to put it together to make it work for their philosophy. How they want to track and understand and know. And it's one of the best features, I think, that we've had for the last 4 or 5 years.
I completely agree. Paolo, do you mind? So far we mostly spoke about the bad side of it and what investors should watch out from when they're seeing an increase of shares, right? But obviously there is like some good side of increase of outstanding and also decrease of outstanding. So maybe give a few examples of sometimes when can it be a good indicator when a company increasing outstanding or decreasing outstanding?
The only reason why is it good for a company to increase outstanding, it's because they're raising money to do something. For example, we see a lot of small biotech companies that are creating novel treatments for cancer, for Alzheimer's, for different type of diseases, and they need to raise money. It's a very expensive endeavor. So it's typical for these companies to increase their outstanding to raise more money to get their funding. It's not nice to see, but that it's going to a good cause. It's going to R&D, and if it pays off at the end of the road, it's gonna pay off massively. So that's one reason why companies.
And again, when you're increasing the outstanding, but at the same time you're increasing the cash, you basically increase the pie. So yeah, my percentage became smaller in the company became smaller. However, the pie grow, right? Because right now, if the company had $10 million and they raised another $10 million, so now they owe $20 million. So even if before I owned 1% and now I own 0.5%, my size hasn't really changed much, right? Like in case, yeah.
You can put it like this, and this is a very nice analogy that I read a couple of years ago. You can have a bigger piece of a smaller pie or a smaller piece of a bigger pie. Either way, you're gonna make money, right? It doesn't matter, for example, if you own 0.5% of a pie that's $100 million, than if you own maybe 10% of a pie that's $10 million. And I'm making up numbers in my mind. They might not add up, but it's the same principle behind it, right? So as long as the company's using the money to grow that pie, it doesn't matter if your piece is smaller, because at the end of the day, you're gonna keep getting more. You're gonna have more pie, but that's only if the company uses that money wisely. So
yeah, and you're asking for some like reasons, right? Like I mentioned, M&A, right? M&A acquisitions, using it as a currency to bring in real value. That's good reasons to issue, right? For growth, right? For strategic investors, right? If they're issuing stock to people that are strategic, like Paulo was mentioning in the biotech space, right? Like if we see companies that are raising money from real healthcare fundamental investors, that's a great time.
yeah, yeah. It's like sometimes I saw recently, well, not recently, a couple of months ago, Merck, which is a big pharma company, they finance a small biotech company, and of course they buy shares. They don't just give them the money; they buy shares. But it's Merck, so it's a big pharma company that's gonna support the long-term vision of that company. Or, for example, in M&A transactions, it's very common to do share swaps. So instead of paying cash, just say, hey, you give me 100 million shares, you give me all the shares of your company, and I'll give you 50 million shares of mine. And in that swap, you get the transaction done, but you don't put out any cash. But you have to issue shares. So you're gonna see an increase in the outstanding, but you know that it's for a good reason, or at least it would be for a good reason, depending on the fundamentals, on whatever. But that's a reason why the outstanding could increase. That might be a good thing down the road. It's not gonna be immediate, but it's gonna be down the road. That's kind of why a company would issue shares, that it's a positive.
Amazing. And what about the decrease in the outstanding? What reasons can it be, and why can it be good, and why can it be bad?
So it can be good because sometimes when companies, especially small companies, don't have enough cash to pay, for example, their directors, they issue shares, or a service provider, or whatever, they can issue shares, right?
Usually that's for the increase, but what about the decrease? So when you see a decreasing, okay, yeah. Go ahead.
I'm getting there. So usually when it goes to directors, if the director believes in the company and I think is gonna benefit it long term, they can cancel those shares. So you're gonna see an increase in the outstanding when they get issued, and then you're gonna see a decrease when they get canceled. And it's common for companies to cancel their outstanding because we go back to the analogy of the pie. You're reducing the amount of slices, so each person has a bigger slice if you cancel shares, and that's a positive. Of course, context matters, reasons matter, but you could say that for that reason, it's a positive for a decrease. Now, the other reason is that companies do something that's called a reverse stock split. So what a reverse split is, you basically take two shares, for example, and you combine them and you make them into one. So what happens is, the pie stays the same, but you get compacted into, one share. Or you can do 4 into 2 or whatever proportion you want to do it. Now, reverse stock splits are usually not positive. That's because the exchanges have rules, right? Every public company has rules. And for example, NASDAQ has a rule that companies need to have a minimum price of $1 or they get delisted. Now, how that dollar is achieved, NASDAQ doesn't care. You know, it doesn't care if it's because of pure interest by investors or because the company is making shares bigger by doing a reverse split. So that's a negative. Usually, it's a negative because what that means is that the companies, their value is so diluted, it's so small that they need to make it bigger artificially. That's the keyword, artificial. It's an artificial increase of the stock price. It's not real, and companies usually do reverse split when their stock is on the floor, when there's no. Imagine, would you as a small investor, would you be interested in a company that its stock price hits 0001? I don't think so, and it's not appealing to any investor. So what you do is you get up a bunch of shares, you combine them into one, and now magically it's worth $1, 10 cents, whatever. And that's more attractive to investors, but that's a bad thing. That's an artificial increase of the price.
That's why normally when a company is doing a reverse stock split, the price is going down. And when a company is doing a stock split, usually the price is going up.
Yeah, the price, it's too expensive for people to buy, so they need to break it up into smaller pieces. But what happens with the outstanding shares, going back to the shares, you're going to see a decrease in the outstanding because the shares are going to get smaller. So let's say instead of having 1 million shares outstanding, you're going to have 500,000, if you do a 1-for-2. So you're going to see a decrease, but it's not a positive. It's because the company's doing a reverse, and it's because there's usually the stock is on the floor.
Got it.
And there's a lot of they can't just wake up in the morning and say, hey, we're doing a reverse split, right? They have to go through different types of hoops and whistles and whatnot to really implement a reverse stock split, right? You have to file it with the state, you have to file it with the exchange or SEC or FINRA, whichever regulatory organization it is. They have to sometimes get proxies, so voting controls. A lot of companies will go ahead and actually will have some sort of preferred class in order to give them the voting controls. So that's a way around some of those things. Some companies, and again, we can look into this into detail and legal and whatnot, but it could be 20 days of notice, 20 days after until it actually gets implemented. They'll come, if it goes into a definitive, they'll give you an X date of where they're going to trade post-reverse and stuff like that. So there's always ways to monitor this, to know how it came about, why it's coming about, and really digging to understand if this is a company you want in your portfolio. If this is a company you want to hold, if this is a company you want to get into. But like Paolo mentioned earlier too, there's a lot of games that companies can do and can make, and we really need to be on our toes in order to see where we want to kind of safekeep our capital and how to make capital out of that. So I think it's a big thing. And I also wanted to stress out, like everything we're talking about here as it relates to outstanding or whatnot. This isn't just going on, on a Fidelity account or Robinhood account and buying stock in the open market, right? This open market, you're dealing with, secondary shares already that are already in the market that you're selling and buying and whatnot. We're talking about primary issuances, share issuances that are coming out of company treasury stock. So it's shares that are coming out between, I mentioned there's authorized of 10, there's outstanding of 5, there's 5 more to be able to issue in between those two. That's the pool of stock that we're talking about, of shares that we're talking about. So wanted to make sure that's clarified as well.
This is very important. This is very important note.
So yeah, again, it's a great tool to track ownership, to understand. There's a lot of ways to decipher the information, and we're here brainstorming and putting out there to show why, how, what can we put together to help the normal investor to really understand why these companies are doing such things.
Yeah, and this came about really because we needed it, because
100%.
we needed a way to track this thing. It's not an easy job. It's not something like Lon said. There is no software that tracks historical changes of shares. So for us to find out, it was very hard. So we decided, we brainstormed, we found out a way to do it, and then we thought to ourselves, hey, this is something that every investor needs to know, not just us. This affects everybody. It affects us, whether on our operations or if you're a shareholder of a company and you only own 100 shares, it affects you too. So that's the moment where we thought to ourselves that this is a useful tool, not for us, not just for us, but for everyone, really.
And why did we choose the analogy of David and Goliath? Do you know the Bible story behind it?
I do. Yeah.
You do? So go ahead, because I was going to leave it up to Ari to explain.
No, Paulo used to go to church.
Let's assume I did. Let's assume I did. But David and Goliath is the story of it was Goliath, which was a giant. A lot of people were afraid of it, and David was just a regular guy. Just like me and you, he was just a regular guy. So he went up against Goliath.
He was the underdog.
Yeah, he was the underdog. He was small.
For obvious reasons. Yeah.
Nobody thought that a regular guy was gonna beat a giant, but he did. It was just a sling. He just threw the rock, hit him in the head, and down he went. And so
the tool. Go ahead.
Yeah, so we decided that it was a good story. Retail investors, especially in the last couple of years since since Wall Street bets, I think, the retail investors, the underdogs, really came into the picture of going up against the hedge funds, which are the Goliaths of the financial world, the banks, the hedge funds, pension funds, whatever. Those are the Goliaths of the financial industry. And you could see that small investors, the Davids, really went up against them, and they put a good fight. And they made them lose money, and they made money themselves in the process. So we thought that analogy of the underdog going against the giants was a good analogy, and that's why we decided to go with that narrative for our tool.
And the tool that we provide is basically the slingshot.
Exactly.
That's what we're providing. That's amazing. Guys, this was fun. I'm really enjoying it.